Hello, everybody. It's welcome to the Brown Janikowski Market Update webinar. Sorry, I was a bit late off the gun there, but I hope everyone can see the slides okay. And I think we've got a live video stream as well. So if I look like I'm distracted at any time, I apologize. I'm just looking up some papers. Welcome everybody who's tuning in. And today looks like a slightly better day after yesterday's sort of red-orange glow Martian horizon day. So I hope everyone's keeping well under these difficult air conditions and everything else that we're going through right now. Okay, let's pop into the to the first slide, and really we can talk about some of the market updates to the election. I will preface this by saying that every 4 years we kind of systematically go through the election sort of prognosis and who's up and who's down and what it means, and generally it's kind of a big nothing. You get some excitement in the run-up, but if you look up and maybe a little bit afterwards, but if you kind of look at the election years over time, you'll see that they make precious little difference, which is very counterintuitive, I know, but I think it's because some of the big issues that can really affect the markets don't, a lot of the parties are broadly agreed on those. Anyway, we'll cover that, but it's not going to be some earth-shattering news about the market's going to swing 20-30% in one direction if one or the other party gets in. So we will certainly continue to go through the exercises, but certainly the last time around we were surprised by the outcome, but the market really didn't take a heck of a lot of notice about it. Anyway, let's just jump right into the kind of summary of what's going on. There is this recovery going on. Those of you who've read our blog have talked about this K recovery. I won't go in that today, but but basically this is not a V-shaped recovery. This is a labor market which had a massive shock to the supply side of the economy, and to a level which nobody has experienced in their lifetime. It might have been the same as 1929. I don't know, but they weren't keeping labor records back then. The labor market is going to be very, very slow to recover. Forget what you're hearing about, the claims numbers coming down. The non-farm payroll numbers last week came in at 1.3 million. There'll be lots of claims like this is the best month ever, or this is the best since March, or something like that. But they're coming from such a low base that they're not in any way, getting us back to where we were. Nothing recently suggests big improvement. We'll come onto that in a little bit, but really we're just seeing the sort of ongoing changes and rather small improvements from the gradual reopenings which are going on everywhere. So everything's going to depend on the virus. We're kind of managing it for now. I think we've kind of stepped into a place, and not just the US, but globally, where it's controlled containment. I don't think we'll ever see another big, broad shutdown again. I hope I'm right on that. But I think what we'll continue to see is people managing it as best we can and changing behaviors quite substantially, which affects the economic outlook for sure. The Fed is now got an expanded mandate. I'll touch on that in a little bit, but they are doing all they can to be as accommodative as they possibly can. And again, this hasn't changed a heck of a lot in the last month since we spoke, except there was an important announcement by Chairman Powell at the virtual Jackson Hole St. Louis Fed meeting in late August. But in terms of their policy, they continue to be very accommodative, and I expect them to remain so for a considerable amount of time. The stimulus, the big one is, as all of you know, there has not been an agreement between the three branches two branches of Congress and the White House on what the new stimulus should be. The last I read, I think the Republicans were down from $1 trillion to $300 billion, and the Democrats were still at $3 billion, and I'm never really quite sure what the White House is doing, but they're kind of executive order ones, which they came out about a month ago, have precious little impact. The expired benefits, which ran out on July 31st, are a big deal. those are really going to impact people in the second quarter, and going into the third quarter, unless that $600 amount is either partially or in whole replaced. I'll just touch on one item there. One of the executive orders that came out was that that employers could not charge FICA. So that's essentially the unemployment and the Social Security benefits for the remainder of the year, and then collect it back in January, which is a very, very difficult thing for an employer to keep track of, because essentially they kind of pay an employee more now, and then they've got to grab it back in the first couple of months of 3 or 4 months of next year. So it's taking like a price hike, a pay hike now for a pay cut later. And it's been really unclear on how it's going to be assessed, and it's meant to be for people less than $100,000. And what would you do if people left the left the company or otherwise changed their employment status? So it's been very full pickup, except for government employees in the military, where it's been and the military, I think, is about 2 million people, but that went into effect this week. So there'll be a slightly more, pay increases there. But from what I've heard, people are going to be very reluctant to spend it if they know they got to pay it back. So we'll kind of see. But the expired benefits are going to have a big deal on the economy, big effect. Recent improvements in the economy are real but slow. We've mentioned that housing and autos have held up or increased very strongly. Retail sales seem to be on a rebound, which is good. But the big stuff, the capital expenditure, which was already kind of in not great shape going into the year after all the trade disputes of last year, manufacturing and of course the trade side are all weak. And we had pretty disappointing trade numbers coming in from last week, where essentially the trade deficit, both for the entire United States and the bilateral one with China, are pretty much unchanged over the last year or so. So, as a net benefit to the economy, trade don't look to trade to be a big part of the recovery. There is a massive increase in Treasury debt, as you know. That is being financed by the Fed largely for now. There is also large demand for Treasury debt, so that is not a source of worry. There are a lot of commentary about whether or not this is going to be some sort of inflation trigger some way down the road. I don't think it is. Some of it is passing into the money supply, but a lot of it isn't. Depends on what kind of who they buy the debt from a primary dealer or a secondary market. But anyway, I don't think, I'm just certainly not in this camp that it's going to be an inflationary cause, now or even, going down the road. So that is something which we can really kind of take off our plate about worrying about. In terms of output level, the economy is operating at what they call an output gap. Was capable of producing 100. Actually, it was $21 trillion annualized, and it's down to 19. So it's a pretty big gap between what it was capable of operating at and what it's currently operating at, and that's going to be around for a while. Unemployment. The employment numbers are looking very strange. I mean, we've got a sub 9% print, but it's very weird the way people are classifying themselves as employed or not. The big issue is that people are saying they're not in the workforce because they're on furlough, whereas they are unemployed, and a furlough isn't always with payment. So the BLS says right on its front page last Friday that they're probably understating unemployment by about 0.8%. I'd rather go with the U6 unemployment number, which is about 16%. And then, as you'll see in a minute, there's 30 million people on benefits. 30 million people is about 18% of the workforce. If they're on benefits, they're not working. So the unemployment number is a nice headline, but it's not really improving nearly as much as it sounds like. I think risk assets are obviously going to be very skittish between now and the election. There's going to be the to and fro of who's in the lead and who isn't. Plus, we've got some normal profit taking and some volatility going on in the market right now. The elections, I think, basically are a concern less about which side comes in, but how it gets there. I mean, how ugly does it get? Where do we? I don't even want to go into the whole disputed election scenario, but that could be pretty unpleasant. And we had a mild foretaste of it nearly 20 years ago, which was a lot less contentious than today, and the market didn't have a good time between in the last couple of months of 2000. So that could definitely be a time where the market has some volatility. Let's just kind of go through some of the slides quickly. Next one, Debbie, can we get? So here we are. This is the famous curve, and there's the United States up at the top, not showing a heck of a lot of improvement. Brazil's obviously another outlier where they've been unable to contain. Now, I haven't put cases here because there's this whole thing about, well, you test more, you get more cases, or, there's lethality of cases. Seems like it might have gone down. So maybe it's not a big, but deaths are real, and deaths are, people die from COVID. I mean, there might be some misattribution of cause of death, but it's probably data noise. But you can see the United States is not doing too well compared to other places. And Italy was one of the first to take one of the biggest hits, and you can see they're down to about 7 or 8 deaths a day. So that's a big improvement, whereas we're still hovering up in the 1,000 side. So look, my takeaway from this is that while you've still got this curve sort of essentially flattening out, level like that, not coming down, you're going to get continuation of local shutdowns, schools not opening, restaurants still not operating at full capacity, and so on. Next one. These are some of the things that the bottom ones to look at here is top left hand side. Look at the deaths. That's the deaths in the US. That's down at the bottom, so a slight rise and then down again. I think it's one of the log scales, so it's just under 1,000 right now. The positivity rate from the test seems to be falling slowly. That's the black slide. I think I put in this students going back, and this biker. The Sturgis rally was held on 7th of August or something like that in North Dakota, and it was a week long. And studies just come out that they think there's a super spreader event. I don't know how many people went, but a lot. I mean, hundreds of thousands, and they think that the number of cases that spread out of that might be about 250,000. So and they kind of went to a lot of places all over the United States. So you can see the increase there, and they're kind of now falling. But I think that not to point fingers at the bikers, but I think these kind of mass events are clearly what people don't want to see happen. And in this case, it ended up spreading it around the country, and so those type of events are likely to be few and far between. And then some cases are rising again in some other states. We got the sort of Arkansas, Delaware, and so on. But generally, it's sort of like better than it was, not falling or improving as rapidly as it should. Okay, next one. This is the Fed's sort of massive injection to the money supply. I put this in just because they're beginning to back off a little bit. They don't need to spend as much as they did. Initially they were in every single asset class you can think of, including buying bond ETFs. I think a lot of those markets have settled down. So now, when they're purchasing bonds from non-dealers, this is what affects this money supply number. You can see that it's gone from like an 80% year-on-year annualized increase down to about 34%. So it's not the Fed's deliberately withdrawing money, so they don't need to do as much as they had to, because a lot of these markets are under control and containment. Okay, next one. You can see that in the Fed's balance sheet, which zoomed up. Those are the annual rates at the weekly change. An annual rate is the black number, so it's about 26%, and the annual change is about 76%, but then we're going from a much lower base. But you can see at the top there that those blue charts are slightly peeling off, and the balance sheet's hovering around there at about 6.3 trillion. Obviously, very big number. Got to remember, this was almost zero pre the GFC. In 2006, I think got up to about 3 trillion at the height of the QEs 1, 2, 3, and so on. So this is a big amount of firepower that was held by the Fed, by the Fed, and they're holding treasury debt and mortgage-backed securities. So Fed is in there and ready to buy. They're buying at about an $80 billion a month rate right now. That could go up if they have to. And so the Fed is got everyone's back on this. Okay, next. It's going to show up here. The Fed is going to keep rates low. I mean, we're always looking at, where do we go next in bonds? We've had a tremendous run up in the price of bonds. And if you've been in a 10-year treasury this year, you've made about 10 or 11% flat out, but the yield's right down there at 70 basis points down at the bottom. And I think these are going to continue for quite a while. And if you kind of took this chart further back, you'd see that they had got almost this low at some point. But if you take the really long chart, you'll see that there's been a kind of big secular decline in interest rates. So what's the next step for the 10-year? Well, I think the range is going to be pretty tight between about 50 and 75 basis points, depending on the time of year. There is a seasonal element to treasuries and the auction sizes, but the treasury is not going to let this move sharply up to 1.5%, 2%. It could go lower. I mean, if there's a big deflationary mess that comes out of the next few months and we find the economy gets hit on the floor again, then you could see those treasury rates go to what the Japanese and the Germans have been going through for the last few years, where it's 30, 20, 10, 15 and negative basis points. But for now, I think that we're kind of locked into that range of 50 to 70. Okay, next one. Let's turn our attention to the claims market. So this today's number came out. This is last week, so I think it came out at slightly better, like 800,000. But I keep on writing about this. This is only people filing claims initially. And it doesn't include the people who are not eligible for claims. In other words, haven't worked in full time or for an employer that's been paying FICA. So a lot of self-employed gig economy workers who are filing under a completely different program, the PUA program, and those are running about the same level. So 800,000 on the normal state claims, about another 800,000 on the PUA claims. And I wish the press would pick up on this, because they're saying, NPR says claims are 800,000. It's like, yeah, but there's another 900,000 people claiming on a separate temporary program. So, the claims numbers are not doing that well. I mean, yeah, they've come down from their height, but who wants to go into the fourth quarter economy if you're looking for a big bounce up with 900,000 of initial claims every week? Because you got to remember that we came from 200,000, and the record before that was 650,000 in May 2009. So these are big ass numbers, and they're almost double what the headline is. But I would say that at least that they're not spiking up. So this is why I write about this every week, because this is really sensitive to what's going on in the jobs market. Okay, let's look at the next one. This is the non-farm payroll. So claims just one side of the job markets, where somebody says, okay, I'm no longer working, so I'll file for unemployment benefits. And the non-farm payrolls is, well, how many more jobs were created? This is a graph with a very weird axis, because normally we'd go along at about 150 to 200,000 new jobs a month. Sometimes a little bit less, sometimes a little bit more, but you obviously it took it all the way down to 23 million in May, and then we've had a number of months where it's been well, last month it was 1.3 million, slightly down on the month before, but these are still lower than they should be, and I think the unemployment rate, the headline there is 8.4. And I think the more likely rate is, I mentioned earlier, what they call the U6, which is the U3 is the headline one, but the U6 measures people who are underemployed. They typically say, yeah, I'm working 10 hours a week, but I'd like to work 40, but I can't find a job. And that's a much better measure of labor market slack. And so that's about 14%. So the bottom line is, this labor market, just like I said at the beginning, kind of very slow to recover. The next one. The other thing that's happening, which I get a little bit concerned about, is permanent job losses. So there's a temporary job loss, which we all know about. You know, we don't need you right now, but check back in a month. You know, business might be better, or you know, the plant will reopen. But a permanent job loss happens when the company shuts down, or the plant shuts down, or the head office shuts down, or you know, something. You know, it's gone. These are now up to about 3.4 million. There's quite a jump there last week, actually, when it jumped by about 1 million, and it's about 2% of the labor force. Now, again, not as high as 08, 09, because you'll see up there it was like 4.5%. That's because a lot of financials just permanently reduced their workforces. I mean, you know, the big banks, if they employed 200,000, they came down to 150,000. They took people off their trading desks or their mortgage originations desks, and so those jobs, we're not getting back into that business. But so it's certainly not as bad as it is there. But you have to worry about the number of permanent job losers, because that means that you know, people's skills atrophy, they lose connection with the labor market. And if they've got both of those things, then they're not consuming, and that's going to be, you know, a harder number for the economy to recover. So again, all looking at employment. Next slide, because you know, this is what drives the economy. As everyone knows, that we're like 60-70% a consumer-driven economy. The rest is trade and capex and government and you know, sort of other non-consumer related parts of the business, infrastructure and so on. But you know, the US economy motors along when there's consumers, and consumers need to be paid, and consumers need to feel confident about their outlook, and they won't feel confident if they feel that the job market is very precarious for them. GDP numbers are going to come swinging back. We obviously took that enormous hit. Here's another graph, which, you know, basically the average took it back to 2005. We've never really broached 2% GDP consistently. You'll see some numbers which are higher than that. That's usually some consumption brought forward for a tax change or something like that. You can see it most clearly when the corporate tax in 2018 came on stream. We had a 3.9% print, and then it promptly just, you know, went back to its normal rate of 1.3. So for the year, you know, it was up maybe 2.8%, nothing like the 3.5 the guys were claiming. So that's normally, you know, we were good for sort of a 2.5, occasionally a 3% quarter GDP. Bam, goes down -5 and then -31. Annualized doesn't mean the economy is 31% smaller. This is annualized. It divided by 4 roughly. We're about 8 to 10% smaller. It's got a long way to go up. As you know, the kind of inverse of this is a 31%. If you have 31% fall, which got down there, you know, 31% gain doesn't get you back to break even. You need quite a bit more than that. So we got estimates this quarter. Those two are over on the right-hand side are estimates for what we're going through now, third and fourth quarter, 21 for 6 and 6.8. I think they might get that. They might, you know, might be overstating a little bit just how much the labor market's coming back. So, but we'll definitely see a big bounce. But when you hear about, you know, a record GDP, you go, yeah, it's a record GDP, but we just had, you know, a massive decline. So we ain't quite back to where we started. But you know, just be braced for those headlines and just treat them with the caution which you would for any kind of reporter. Okay, next one. I'm going to skip over. This is basically just talking about the employment ratio, which has fallen down, and then we've just seen participation obviously drop off. It's interesting to look at it by age groups. So the one you want to probably look at is the one which is in the sort of 25 to 34 and 35 to 44. Basically, all those lines except for the one which is the one for 55 years and over. So yeah, participation is falling. And if you kind of burrow into that, you'll see that, you know, younger people's participation has fallen more than the average. Women's participation has fallen more than the average. So this is people taking themselves out of the labor force, you know, probably not by choice. So so we got to have to watch for this, because you know, labor force was already declining for, you know, for demographic reasons, and this is obviously going to accelerate, and we want to see that stuff come back. Okay, Let's look at let's talk about the labor force, which is I spent a lot of time on, but it's so important to consumer confidence. This is just what's going on. Actually, that's from June. Let's go to the new one, September, which is the next one. We've had a lot of economic data is backward looking, like, you know, so and this is so current that we're kind of looking for indicators of, you know, what's going on in the economy on a kind of a now basis. So there's a number of people have put out these proxies, which I think are quite helpful. So at the bottom left, you can see TSA checkpoints. You know, it obviously went to zero. You can see it's sort of increased and it stayed pretty flat. The next one on the left, no, there isn't a slide missing. It's basically showing restaurant bookings in those various different states, and they literally went to zero. I mean, that's measured on 100%. So they fell by 100%. They're closed. And they're slightly coming back. There's a few dips over there, you know, on the far right hand side, but that's pretty current. But that's encouraging. Then we've got the number of flights tracked, and again, the top 4 lines are what was going on in prior years, and the bottom line is kind of where we are now. And again, it's getting closer to that. These are global flights, and they're both commercial and passenger. So they're getting better. Not in the US, but in other places, the number of flights being tracked is improving pretty well. Although you can see from that little dip, it's certainly by no means you know, a straight up line. And the last one is just hotel occupancy, which, rather like bookings, you know, went pretty darn close to zero. I've left the scale out of that. Sorry about that, but I think it's at the bottom. It was about 20% hotel occupancy, and hotels normally run at about 80%. So they're still quite a ways below what they would normally be. So, yeah, again, the story is you know, getting better. Not a straight up number, not consistently better than the depths for sure, but not a sort of a nice tick upwards, which you'd expect or would hope for. So we just got to be patient on this. Okay, next one. Again, just to quickly talk about inflation, because there's some weird things going on with the inflation numbers right now. Some things like used car prices are going up because there's people who are saying, I'm done with public transport, or they've moved out to the suburbs or something like that. And at the margin, the demand for some of those things has gone up. So some foodstuffs, so some oil, and so some gasoline, just because, you know, we were down to $20 a barrel. Now we're at 35, 40. But this is what the Fed looks at, and you can see that you know, we're really kind of nowhere with the inflation target. So we're running consistently below 2%. So I always bring this one up. I know it's a long-term chart, but it's very difficult to bring out, you know, high inflation with this economy. The sooner, it's not going to happen on the wages side for sure. So it's very difficult. So the only way you get price inflation if people start reducing their savings. But otherwise, I think inflation is a non-issue, and I think likely to remain that way. Okay, next one. The other thing that's happening with the consumer, again, there are things we have to worry about them. You know, certainly the labor, the employment side, their ability to go out and consume, but they're not indebted. And this is a big difference from 2008, 2009. So you can see that they actually reduced. This is revolving credit card debt and non-revolving. So credit card debt is revolving, non-revolving might be an auto loan or something like that. But they're way below what they were in 2008, 2009. You can see that from the percentage change, just monthly percentage change. So they were running at, you know, 4% a month change back in 08, 09, where people were just going crazy with debt. This is not, now we're down to 0.3, and we had a couple of months, you can see in the top blue line, where people actually just paid down their debt. So so this is not a heavily debted in consumer, which is good, because if they were, then we'd be looking at a lot more concerns about bank loans. We'd be concerned about, you know, people's future ability to you know, get credit and be able to start buying again. But right now, this is not a recession which is going to bankrupt a lot of consumers, and that's a good thing. So so that I think a lot of people were burnt after 2008, 2009. Okay, next one, consumer confidence. You can just look at the lines there over the right-hand side. They're all kind of come down quite a bit. This just kind of measures everybody on the blue line, and the under 35s were, finally kind of getting a little bit more confident, and they've fallen quite a bit just because, in percentage terms, that was probably the biggest hit in the age cohort. Yeah, I mean, it makes sense. People are not overly confident about being able to keep their jobs and probably deferring big purchases and so on. It's no big surprise there, but we all need that to happen before this economy really starts moving along. Next couple of slides just very touch on two areas which are doing well. So this is the auto side. They've come back pretty quickly. So the blue line is where you add in trucks. Everything's a truck. Everything from a Honda Fit, F-150, your Honda RAV4 and CRV. All these guys are trucks. Don't ask me why, but that's just kind of the way they're designated in order to get past very old trade regulations. And then the cars are your kind of your Honda Civic on 4 wheels and your Corollas and things like that. Big decline down here is because people are not buying cars; they're buying more, 4-wheel drive, sport utility vehicles and that kind of stuff. But basically, you can see that there's a nice snapback on the V with the blue line. So yeah, down from its peak, but went down to 9 million vehicles on an annualized basis, and now it's back up to 15. So this area is doing well as well. Again, people who are changing their commute patterns or don't want to be on public transport, go out and buy a car. Also, the average age for a car buyer, I think, is about 51, 52. So this is not an age group which is overly affected by the recession and job losses. It's the younger people who are. And next one, pretty much the same going on in the housing as well. Again, the average age for a buyer of a house is like 47. The average age for the first-time buyer is about 38. Used to be about 32. So these are new home sales, and you can see they've recovered pretty darn well. I mean, they went down from about 600. They snapped back very, very quickly, almost, to a 10, 11-year high. We're still not building as many houses as we need for the population. So this, again, is, a part of the market where people are either moving out of the cities, deciding they want to pay rent anymore, and there's that they're buying up new properties, and these are both houses and multifamily units as well. So that is a good indication. So different parts of the economy doing well. Consumer obviously under quite a bit of stress, but the new home sales and housing generally, and auto doing well. And home is very important because the biggest single source of wealth for nearly every American, on average, is their house. So if they're feeling that they've got a house, and even if they net off the mortgage against it, that seems to be doing well, and house prices are holding up, in some places going up quite strongly, that's going to help the confidence factor, which is not so good from the labor confidence side. Okay, next one. So yeah, I thought I'd put this in. I mentioned in the blog the other day. This is kind of shows the S&P in election years, and sometimes the market goes up, and sometimes the market goes down. On average, it goes up about 7%. On average, goes down about the average gain over that period is about 7 or 8%, and an average up year is about 12 or 13, and average down year is about 11 or 12. The trouble is that these numbers are exactly the same for every other year as well. So there isn't a lot to say here. I think it's other factors. Obviously, 2008. You'll remember that election. I mean, it was there was just all hell was breaking loose on the mortgage and the financial side. It didn't, the election was almost a sideshow as far as the stock market was concerned. So the point about this is there are really other factors which are going to affect the market, and I think that they're going to be more important as we go forward than just the fact we've got an election year. Okay, next one. I'm just looking for a piece of paper here. I thought I had it. Yeah, I just made some notes on the Biden stuff. I'll just try and remember it. uh, it's really the last slide, but we don't need to go back to it. So the thing I think about the Biden, if Biden gets in, then I think almost inevitably corporation tax will go up. Now remember, it went from 35 to 21, and the talk is that it'll go from 21 to 28. But the effective tax rate for the S&P 500 is much, much lower than that. The top five, the Apple, Google, Facebook guys, they're paying tax rates of about 13%. So 13 versus 21. So these guys are not really affected by a big change in the corporation tax. The only companies paying anywhere near the maximum are all domestically owned or domestically operated. They've got no place to push their profits overseas, or they're not doing a lot of capex. So it's very few companies are paying anything close to the highest corporate tax rate. The effective tax rate for the S&P right now, I think, is about 16, 17. So let's just give it the benefit of the doubt and say it goes up about 5%. So that could be a direct hit to earnings, if not, all things being equal, of about 5%. I think the market will adjust to that pretty quickly. The other one is the income tax level, going from whatever it is, 36 now to 39%. But we didn't see a huge benefit to the economy when it went down that way. Why? Because most people who are in that bracket tend not to be big, to have very low marginal propensity to consume. So if you're in that kind of tax bracket, you tend not to take your full 3% tax benefit and go out and spend it. You tend to sort of save it. And I think exactly the same will happen the other way. I don't think there'll be some complaining and moaning about it, but I don't think it's going to have much of an effect on the economy. It's the only thing I'm interested in, not the not the sort of personal side of whether we should be paying taxes more or not. And so I don't think that will have a big effect. And then there's some talk about capital gains tax being increased for people with over $1 million in income. Again, the number of people who are affected by this is, at tops, less than 1 million, out of 150 million taxpayers. So I don't think it's going to have a big effect on the market. Healthcare, I think obviously that's, we're so far away from the kind of Warren Sanders healthcare policies that the health sector has bounced back very strongly. I don't think they're going to be particularly concerned about what might come from a Biden policy. I might be wrong, but it would show up. It wouldn't show up in the drug or pharma or device companies quite yet, or hospital management companies. It would show up in the insurance companies, the Humanas and Aetnas of the world. Well, that's not public anymore, but CVS, who owns them, I can't remember the other one, Cigna, place like that, and they've done fine recently. So I don't think the market's particularly concerned about that. And on the plus side, I think we'd get more of a policy around COVID. It might not be any better, but I think what we're lacking right now is a kind of national economic, federally directed national policy on COVID. I mean, it's down to the states, and I think there probably would be one which would give people a little bit more incentive for optimism, and then any expenses around infrastructure and healthcare are likely to be far more targeted than just the tax breaks that we've had the last couple of years. So that's kind of my quick take on the Biden election. But as I said earlier, I think it's less about what he's going to do when he gets in, and more how the election's going to be played out over the next few months. This is the S&P. I'd like to show this one just because we've had a lot of volatility over there on the right-hand side with the S&P, but earnings are down from a peak of about $143 a share for the entire S&P down to 121. So that's about a 15% decline. That's quite big, but it's not nearly as big as the price changes. And dividends have held up pretty well. There are some cuts for sure, particularly amongst the financials, but we're not looking at 20-30% cuts in dividends. They've held up pretty well, and that's important in this market where the S&P is right now on a yield of about 1.8%. So that makes it quite attractive relative to other asset classes. Okay, next one. Yeah, I kind of refreshed this one. We've had a kind of a stock market where it has been pretty top heavy. I think everyone has recognized that. If the top five, which I've already mentioned, there they are since January, up 46%. Yeah, they're down from up 60%, but that, that's a correction which takes you back 4 or 5 weeks. That's hardly worth the the definition of correction. I don't know what the correct prices for these stocks are, but they generate boatloads of money. They're kind of operating as quasi utilities monopolies, and they don't seem to be no one seems to be too bothered about that. They might have some more legislation pointed at them, but it's going to be a slow run. These are huge cash generating machines. They're a little bit expensive, but they're not as expensive as they had been in the past. And I think it's sort of somewhat justified that they've had this big run. But then you take the next step down and the S&P 500 is up about 5%. Obviously we could have a day or two where it's different from that. And the large companies, which include the top 5, are up doing better than that. And it's the small and mid caps, which are, picked up nicely in July, but since then they've kind of stalled, and that makes total sense because small and mid cap are much more tied to the economy. So everything we've discussed with the economy, whether it's the labor market or the GDP numbers or what's going on in CapEx and FedEx and CapEx and trade, manufacturing, all these have shown better increases, but have slightly plateaued over the last couple of months. Okay, over the last 6 weeks actually. Also, we've just seen this huge disparity. Here I've taken the tech and consumer sectors, so we pick up obviously the tech companies, but also the Walmarts and the dollar stores and Amazon and Netflix, which are in the consumer area. And we've just plugged them against the energy and financials, which are in pretty bad shape. They've leveled off the last couple of months, but they're going to take a long time to get back to that. And so we've seen this kind of disparity in the market between the best performing sectors and the worst performing sectors. Okay, next one. Yeah, generally the S&P has become more of a growthy type of market. These are what I would call the defensive sectors. So they're only about 12% of the market now. So the defensive sectors were, because we at the top left, it's all the consumer staples, so the Procter and Gambles of the world, the utilities, the Duke Energies of the world, and the wireless telecom, it's the kind of AT&T and Verizons of the world. These used to be sort of kind of classic defensive stocks, and they had a pretty good run going into 07, 08. They tend to do pretty well in a market scare. They did okay in 2019, but they're okay, but they're just a small part of the market right now. They used to be, a third of the market over there on the left-hand side. They're much smaller now. Why? Because there's just a lot of these guys have been taken out, or they've gone smaller, or they haven't performed very well, like a Heinz, or it's just got the top guys have just been moving ahead far more quickly. So, the US market has got fewer defensive sectors than it used to. And so we've got to be aware of that when we make equity allocation choices. Okay, last one. I think, so it's kind of do the wrap up. I think in US large caps will remain in focus. The tech side is just doing very well. We'll probably have continued, good, strong numbers coming out of the big 5. Apple's going to ship, I don't know how many, 70 million new handsets this in the fourth quarter or something. People like their services businesses. These are guys which are, they're going through a recession, but it's a very growth recession for them. And the marginal cost of adding new clients or new businesses for someone like a Facebook or a Google or even a Microsoft and its cloud business is zero. So it just falls right down to the bottom line. There aren't a lot of businesses that do that. International, I think, will start to benefit partly from the lower dollar, but the trade issues. China has come back very strongly on trade. The US not so much, but I think some of the European companies will benefit from that. Worried about these permanent job losses increasing. We'll keep an eye on that. Definitely going to see rates low because the Fed and every other central bank is on full ease mode. The income replacement really depends on the next round of fiscal support, which seems to be tied up right now. I think I doubt that it's going to get done in the next few weeks. It seems like the 3 groups are pretty far apart. So if it doesn't, then you're looking at January, February, and you're going to see a hit to personal income going on with that, with the withdrawal of that $600 a month stimulus, which is going to start to bite in the next few weeks. But that has implication for rents if you're sort of owning not so great real estate with rents where either got small businesses or individuals, you know, where rents might be withheld or in forbearance and spending, but it won't, I think, affect a lot of foreclosures, and we don't have a lot of high credit card debt, which is very important. So again, because the consumer is not financially stressed at the moment. Whole thing depends on reopening. Seems like it's obvious, but every time, you know, we get a little bit of an opening, another school district opens up or half opens up, all that helps enormously. Obviously, the sectors which are, you know, big into mass grouping are, you know, so the leisure industry, you know, hotels, concerts, you know, the list, are going to be under some stress, but other parts of the economy are coming back, you know, slowly but surely. I think on the portfolio side, you know, we're still in treasuries because, boy, we got a week like last week and the treasuries rally, and we're not quite through that hump yet of feeling that the market could have some hiccups, and we continue to use the buffer notes, and we continue to be in things like our very high quality bond portfolio, which is got some very, very strong credit standing behind it. But I think, you know, bottom line is the election's going to be a little fraught. I would be surprised if we have a smooth ride between here and November. So on any one day, it might look a little ugly, but I think we'll get through the other side of it. The underlying economy is slowly improving. Look, thanks very much for your patience. Gosh, I feel like I've gone through this quickly, but also tied up a lot of your time. I don't know if we have any questions that you'd like to throw in here. I think we have a question system. And it looks like I'm getting the sign that I think we're all set. So again, if anything comes into the come to mind and you want to like ask any questions, I'm happy to take them. Seathwaite's at B&J Advisors, or just go on our website and there's some contact email addresses. We're happy to do it. And thanks again for joining us. Okay, I am going to read the disclosures. So I know everybody likes this bit. So here we go. This discussion of the investment strategy, research, investment process of Brown Jankowski LLC of the date indicated, or as of the date of this presentation, subject to change without notice. Chances illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We can assure that types of investments mentioned in this presentation will produce the intended results or outperform any other investments in the future. We reserve the right to change our investment perspective and outlook without notice as market conditions take and as additional information becomes available. Diversification does not protect an investor from market rise risk and does not ensure profit. The information is subject to unintentional errors, omissions, change without notice. While we gather this information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements numeric later in the presentation. References to individual security should not be construed as a recommendation to buy or sell that security. The securities noted in this presentation are any several of the successful and unsuccessful investments by Brown Jankowski do not represent all the securities we have purchased, sold, or recommended. Index returns include reinvested dividends and interest, but do not reflect commissions or transactions route. Mutual fund returns include reinvested dividends, capital gains distribution. Mutual fund returns net of fund expenses, however, do not reflect Brown Jankowski's fees. Please read the prospectus carefully before investing or sending money. Past performance no guarantee of future results. We may reference various hypothetical investment illustrations. These are illustration purposes only and not for investment recommendation. Do not guarantee indication of future results.